without further ado, Peter Goodburn's here with us. Peter is my trading warrior brother. I've been talking to Peter for years now and always come away with some interesting views and things to consider in my intelligence gathering. So Peter, welcome back to F.A.C.E, my friend.
Great, Dale. It's great to speak to you again. Happy New Year.
Happy New Year, buddy. I hope the pips rain down on you in 2019, and I really appreciate you taking time out of the day. And what a great day for us to be talking with the ECB. I believe that you have some type of line in the sand in the euro for a continuation move of. You want to start with S&Ps? Okay, that would be fine too.
No. I just saw a little prompt coming up on my screen, so I thought I'd better click it.
Okay. All right. So let's start here. So we had that rally in the S&Ps Friday. You know me, I kind of look at eclipses and change of seasons and things like that. Actually, the eclipse put in a short-term top in the S&P. Is the recent sell-off this week enough for you to call it, say, I know your terminology would be a reversal signature? Have the S&Ps signed on the dotted line yet, or do we need more evidence?
Yeah, I think we need a little bit more downside to really be confident of that. I was just checking this exact situation last night just to see if the indices could stretch just a little bit higher, and there's one or two other sort of short-term signals coming through on some peripheral indices which could allow it to trip up, but I think the upside is pretty limited, to be honest, at this juncture. And the bigger question I'm trying to answer is just how far do we drop next? That's going to be the next I think important thing to answer, really.
Okay, so what are the alternatives? Are maybe some type of fib retrace from 2912 or so, or a washout is also a possibility. I think someone I know, some people subscribe to you that are friends of mine, and I think you were talking about a potential of an ending diagonal if we had a washout.
Yeah, I think. Can you see it here?
Yeah, we got it.
I've activated the right screen.
Yeah.
No, but the reason I'm thinking in these terms, this is the diagonal that you refer to.
Right.
If it is going to work, we're going to have a 17% drop, which is, pretty difficult anyway to envision. But of course, these movements are very volatile, and we've seen one from October's highs down initially, and then of course in December. So we shouldn't put that aside. I sort of operate my Elliott wave counts with a certain logic, and I go through a certain sequence of logic, and that serves me pretty well. And this diagonal pattern is a part of that logic process, because I'm just going to highlight my drawing pencil. Because when we started this downswing, we have a very significant 3 price swing decline like this.
Right.
And then we go through a bit of a correction, which is called a running flat. This ends here. And then we go through another 3 price swing event like that. And of course, these are very much part of a diagonal, an ending type. And if we have a look at wave search and we go through, here's the diagonal pattern.
Okay.
And when it's an ending type, in other words, it's the end of a particular corrective pattern, we get, let's put in some subdivisions as well. We can see that wave 1 is a 3 price swing decline. Wave 3 is a 3 price swing decline. And wave 4 is usually a whopping 76% correction of wave 3. It really comes up very high. And I can't ignore that, because this is exactly what we've got. This is about a 76% retracement. If we go from, let me take these away a second. If we go from here down to here, you're coming into the 76% level.
Yes.
Look.
Okay.
And
yeah.
This is a common action. And of course, we've got 3 price swings in each of those declines. So we can't ignore the fact that this is a possibility. And of course, it would be of concern to see something like that drop, but it's certainly within the realms of probability.
Okay. The other scenario would be what? Some type of fib retrace and then another run towards 2,800. I've seen counts like that too. Maybe it doesn't fit with your wave work. It's amazing to me, Peter, how many interpretations there are from different Ellioticians. So I know it's fun. There's one or two alternate counts always, right? You have an alternate count, but when I talk to so many people that there are more than two alternate counts. So
well, I have to tell you, it drives me crazy. It drives me nuts when it does. It drives me nuts because no, I'm actually.
You're not the only one. Greg is an Elliotician with us, and you know what? Does it drive you nuts because you have so much faith and belief in Elliott Wave that when you see a practitioner who's breaking all the rules, who is putting out Elliott Wave stuff, you almost feel like it taints the methodology.
Well, that's exactly right, and it does drive me nuts for that very same reason. Because I think that there should be an ordered process of evaluation in this. Otherwise, it's so subjective. And Elliott Wave is right when it receives that type of criticism, because there's a lot of practitioners, even some of the most renowned household names, makes very simple mistakes, and that's why it does drive me nuts. I think we have to follow a cohesive, line of logic when we approach Elliott. And if we fall outside of that range, then we do deserve that criticism. But when I've applied,
what keeps your work cohesive, Peter, compared to others?
Well, because I do follow a particular line of logical thought. I mean, I think people tend to sort of try and manipulate it into what they want to believe. I mean, for example, if you take a look at this decline, this initial decline, that is not a 5-wave pattern.
Right.
Now, look, you can believe, you can trust, you can think of it as that if you want to, but it's not. It's not. I mean, I'll just show you. I've kept this screen up because this is the initial decline on the futures, and I keep this up to demonstrate this exact purpose. If we measure, this is the initial decline. Okay, we're going to measure the first downswing here. Now, I think you can see that there's a good, valid 5-wave process there. If you subtract it from the rally, look where that 100% line is. Now, that is statistically a 99% probability that has declined as a zigzag. That not only conforms to the 535 substructure, but you're getting a perfect 100% equality measurement.
Okay.
So if we're declining in 3 ways, okay, from that high. So we've got 1, 2, and here's the 2 measurements. Now, the correction can come through. Now you might say, well, that can be 1, 2, 1, 2. Okay, this high here, here, it doesn't break that one. So you could be super bearish. You'd go 1, 2, 1, 2. That's okay. But what happens if you look at the same pattern in the Dow? Well, okay, a lot of Ellioticians, they won't want to go down that road because it contradicts what they're saying. But if you take a look at the Dow futures, this rally, initial rally, traded above here, look.
Yeah.
So you can't call this 1, 2, 1, 2. It has to be a zigzag. Now, of course, this type of intrinsic investigation by doing comparative analysis will bring you to ultimately the right answer. But there's a sequential process of logic that you have to go through. It's cohesive, and you have to go through that process. A lot of people are just looking at one index, or they might say, well, that sort of fits. Let's forget that. I don't understand that. Let's leave that aside. We won't even mention that to our subscribers or our clients. I mean, this is, to me, really what drives me nuts, because it just means that, that they're going to be open to errors. and we have to go through the process. Now, when you said alternate counts earlier, okay, we've got this diagonal which fits basically the logical process of inclusive zigzag pattern here, inclusive zigzag with the elongated C here. And at the moment, the proportionate relationships in this upswing conforms to a correction. So we have to say the probability of a fifth wave is still there. But what happens if we develop higher, or we go outside this range, or whatever? What is the alternate count? And does it still conform and maintain these zigzags? The answer is yes, but there's only one other possibility. Only one other possibility, and that's this pattern.
Okay.
This is a triangle. Now, stay with me on the logic. Here's the same zigzag decline. We maintain that. Here's the same zigzag decline in the next sequence. But that can be a double zigzag. But it can also be wave C within this larger structure of a triangle.
Oh, a regular B at 2940 with C down to 2346.
We would get an irregular B. This is A down here.
Right. B was at 2940. It's an irregular because it made a new high. That throws people off.
And absolutely. And that drove me also nuts last year, because everybody started defaulting, saying, oh, look, we've got a triangle here. We'll do a little triangle there. That will tidy that up. But the validation of a triangle is inherently poor, because look, you're supposed to, in a triangle, you're supposed to keep the boundary lines so that these waves touch. If you draw the boundary lines there and there, you can't include the top. And also, if you try and do that on several other indices, peripheral indices, it's impossible. Hey, try and do that on something like the New York Stock Exchange Composite Index. Now, I'll show you can't do it. It's not possible. Yeah. So please, you've got to try and make sure, if you're going to do this logical process and do it thoroughly, that you've got to make sure that everything conforms and fits together in a neat bundle. Otherwise, your whole thesis is falling apart.
Let me ask you this, Peter. Different indices have, even though they might be in the same type of sector, like let's use a broad stock indices. So are the best trades when most of them are in harmony and saying the same thing, rather than perhaps a couple are saying one thing and 3 or 4 are saying something else? And how do you rectify it?
Well, you have to, it's a good question. I mean, you're the best at asking these questions. This is great, because when you get, say, positively correlated indices, and they have slightly different quirks, which they do, each of them have pretty much slightly different quirks. The great thing is that if you can reconcile those quirks through the Elliott wave count process, and they keep the pattern integrity whilst the synchronization alignment is still there, then you have really the very strongest signals, and your conviction level goes way up. Okay. You don't need then about 5 different wave counts, because how can you trade a conviction level if you've got 5 different possibilities? And you can feel it through someone's voice if they're telling you something. Oh, well, but this could, that, and then it's. I mean,
or you open 5 separate accounts.
yeah, exactly. Well, we know that little game. But, yeah, but what I'm going to show you now is a sort of a compilation of my worksheets with some peripheral indices. Now, this is the New York Stock Exchange Composite Index. To the top right, we've got the World Global Stock Index. This is the Banking Index, bottom left. And to the bottom right, we've got the FTSE All World Index. Now, this was the same development last year. And I actually like these patterns because they show an inherently different concept, but they have pattern alignment. So when we start looking at 2018's inherent decline, look at what happened when we started to recover from the February lows into the late September period. We didn't get higher highs on any of these.
Right.
And yet they had conformed to certain prerequisite patterns, double zigzags, namely most of these, particularly the banking index. And they got down into some really nice bid price ratio levels into those December lows. So these ones effectively are putting in quite a significant low. And importantly, what's happened since is that these upswings are developing into 5 price swings. So, okay, that means that it secures these lows. I doubt very much if they'll break, but have these 5 price swings ended yet? Well, they could squeeze up a little bit more, but it means that upside is limited. Once that's finished, we can get a very good secondary retracements. And as you know, second waves can be very deep.
Yeah.
And they can come very, very close to breaking the low. And they also they can masquerade and imitate impulse waves, because they start something like this. They come down in a little move, they rally, and then they suddenly accelerate like a third wave, but it's not. It's an elongated C wave, and this is very typical of second wave retracements.
Okay, so Peter, there's your forecasts are excellent, but I think we could have a little teaching experience here. Somebody that's watching us right now says, Peter, you say your S&P wave 2 is a running flat. It can't be if you're calling the whole thing a diagonal down. Wave 2 can only be a zigzag or multiple zigzag. What say you, Peter?
Which chart should we refer to? Sorry.
So Manny, which chart are you talking about on the S&P? I asked your question.
Let's go back to, do we go back to this one?
That's probably it. Anyway, okay.
Say it again to me.
Okay. You say your S&P wave 2 is a running flat. It can't
wave
be if you're calling
running flat.
It can't be if you're
here. Oh yeah. Okay. Yeah. Here's a running flat.
All right. It can't be if you're calling the whole thing a diagonal down.
Why not?
I don't know. This is Manny. Wave 2. He thinks that wave 2s can only be a zigzag or a multiple zigzag.
No, that's not correct.
Okay.
No.
See what I mean?
Not
Everyone
correct.
thinks they know the rules. So
I don't know where the logic of that comes from. That's definitely incorrect.
Okay. All right. See, that's the confusion with Elliot. If people really want to learn this, Peter, where do they need to start? Besides having a mentor.
Well, I think some of the questions that Manny sort of said is good, because it's very specific, and a lot of books don't go into that type of detail. So I'm just going to show something here. Let's look at, I'm actually building a database, an historical database, so that perhaps at one stage we'll be able to sort of feed in different types of second waves and look at them. But I haven't got that historical database working yet. But if we go into something like a second wave correction within an impulse decline, well, let's put in the diagonal, and here's the one specifically that we're using, and we click on permutations and we say, right, what's possible for the permutations of wave 2? Okay, I hope you're still looking, Manny. But if we load, actually what this search result is doing, it's saying that wave 2 within an ending diagonal can be a zigzag, double zigzag, a triple zigzag, an expanding flat, or a running flat. Okay, so we've already got historical references, and we've built the tutorial pattern around those historical precedents.
And this is all available to subscribers, these tutorials? No,
we haven't published this wave search engine yet.
Okay.
It's an ongoing project which I've been trying to get out for 10 years, and I just have, so we use it internally. But I'm going to click on the all the results here, and you can scroll down. So here's the zigzag that wave 2 can unfold into. Here's the double zigzag, the triple. Here's the expanding flat even, and here's the running flat. And that can unfold into wave 2. So yeah, I've got historical precedents somewhere locked up in my database, and it will take me a while to find them. But ultimately, the idea of this project is to give exactly these types of answers. So thanks, Manny, for the question. Yeah,
I think that would be a great mission for you, Peter. So, really appreciate you taking the time during this interview to educate and edify people that are looking at this. But everyone's here to try and find a way to make some money and sense out of the market. We have your S&P call. I know that your view used to be that there was going to be one final drop in gold after this rally to 1160 and silver to 1313. I'm told that you have changed your view because of the character of the rally that we had since then in 1-2s. Is that correct?
Yeah, absolutely. Yeah, I thought that we would do a pretty normal horizontal flat here. So you've got horizontals, and generally we would get 5 waves down from up here. And when we started in January, don't forget that January last year, yeah, we knew that there was going to be a top somewhere up here. I wasn't certain whether it would stretch a little bit and break the high, suck in everybody, and then drop down. But the idea was that it was either going to be a flat or an expanding flat. And we got this initial downswing rally. I thought that this was a tight enough channel in here to be a third. So when actually we saw the August low and we said, no, that's a nice third wave, we got a 3 price swing up into October. We thought, hey, this looks okay.
Right.
But the alarm bells began to ring because that successive decline was only 3 waves and it measured like a zigzag. And we thought, oh, that's a bit strange. If we start to break above here, that's gonna start looking a bit too tight for a 4th wave to be prolonging this sequence down. And it was only when we started to kick on up here a bit further that we realized, no, this is not going to work. We're not going to get down into any lower lows anymore. And this ended up classified as a running flat. Now, it's not one of my best forecasts, but well, that's reality. As soon as we got the message.
Okay, so W.D. Gann says if you don't learn how to change your mind, you won't have any change left. So you were looking for that recovery, but you started getting evidence. It's always a process of assessing and reassessing. So now we have significant lows in at gold 1260. Is there going to be more of a pullback? Because I know you're pretty constructive on the dollar, so gold could fight dollar strength. And I had a gentleman who's a gold guy who said what's important now is he was looking at the euro against gold that could be on the verge of gold breaking out against the euro. So is this going to be the reason gold is good is because gold is good not only against the US dollar, but across all fiat, which is kind of unusual, where, you know, gold's going to appreciate against the euro, the dollar, everything?
Well, the dollar euro, or sorry, gold euro terms has been trending up for the last couple of years.
Right.
And that's purely because of the currency. But the one aspect which I think is important to understand is that there's been a great shift in the way that large investment houses are trading gold at the moment. Previously, it had been dollar orientated. So when we started to see the dollar top out in August, that was corresponding to this low. When the dollar index started to undergo a sort of retracement, we started to see gold pick up. But of course, since then, the dollar's been steady and gold shot up as well. Right. And that's because of the stock market. The stock market started to slide, and some fund managers definitely started to switch their asset books across and started to use gold as a sort of pseudo hedge.
Right.
And I think that that's still in their minds at the moment, because when we get this breakup eventually above 1243, but you can see that gold is moving up in little steps, and it did so as a smaller version of these 2 sequences. And we refer to these as a series of 1-2s, which is a precursor to what we call as a third of third extension. In this case, it's third of third of third of third, because we've got 4 1-2 sequences. But you can see that we suddenly get 5 price swings up to here, and we're going through a bit of a correction. I don't know whether this will hold at 76. I thought the other day it might trade a little bit below that to about 68 and then resume up. But I don't see that gold, even with a stronger dollar, I think gold will be able to withstand that. And this can only bring me to the conclusion that we've got a severe downswing coming in stock markets, and the fund managers are going to just bid this up again.
Okay. All right. So you have upside potential of around 1320, or are there longer term implications? Because some of your longer term commodity counts are, quite a bit higher than where we are. Could this be the beginning of the wave to challenge 2011 highs?
Oh, absolutely. Well, 2011 highs, maybe not necessarily, but we first got to get up to 1413. I've extended this series of 1-2s by 1618. That's something I get in the habit of doing at the beginning of such movements.
Okay.
And that gets up to 1413. That's about $17 for silver. But if we take a look at the bigger picture, we're going to start seeing what we'd hoped for after this consolidation phase, which is, let's move along to this one. Now, this means that this is the 1413 area up here.
Yeah.
So this will be wave 1 of 3.
Okay.
Wow. And this is a super bullish count, by the way, if we get hyperinflation and the dollar collapsing. We know that the dollar's going to collapse at some stage. But I have to say that 2 years ago, when I first looked at this scenario during the 2016 advance, I was pretty convinced that we would see gold into new record highs, but I'm not so certain anymore. And the reason being is that when gold moved up in 2016, we did a 33% upswing here. But the reason why I was plotting gold in that early stage of this upswing into new record highs was because I knew with a high degree of confidence that the gold mining stocks like Newmont Mining would go to record highs and they would tenfold multiple. And I thought, that should bring gold into new record highs. But since then, this did 30% and Newmont Mining did 300%. Now, that means that this upswing may not ever break into new record highs. And I'll show you what the scenario would look like if we find that bullion is going to be really underperforming the mining stocks like they did before. We would be ending up
because right now bullion is stronger than the miners. The miners look pathetic with this gold rally we've had over the last few months, don't you think?
Yeah, they do. But they're only being held back because of the overall implication of the stock market.
So they're being treated more like stocks than gold.
Exactly, but that's going to change pretty soon.
Okay.
And you can see here, the alternate count would be that the super cycle finished up here in 2011, and we're simply going through a zigzag. So A, B, and C will scratch up here. And so I don't know. I mean, I think we need to be long of gold. I actually like. I mean, my God, did you see Gold Corp? Did you see Gold Corp made a lower low. Look, that was the only gold stock that I tracked that actually made a lower low than 2016. But I still think this represents an excellent buying opportunity. And I've got even some hedge funds on my books who are looking to trade this on the gold stocks, the indexes like the gold miners and the small cap, the juniors.
Nugget.
Yeah, on a leveraged basis, 3 times leveraged basis. I mean, my God, I mean the percentages are really crazy.
Yeah,
and don't do that unless your wife wants to come and beat you on the head. But I mean, my God, there's so much opportunity here. And if I show you, the crazy thing, how that translates, this is an expanding flat pattern, by the way. So we got 3 down, 3 up, 5 down, and this is the same theme that we're looking at on a lot of gold miners. I don't know. I have an alternate count on this one, I have to admit, because it made a lower low break below 2016. But if you look at this in Newmont Mining, there's no doubt to me that we're going to go to 166 on Newmont. I mean, we can take a look at that here. But to me, this is really sort of got huge potential. So you don't even need to leverage on this. You can just put this into your pension fund or whatever. You don't need to leverage. And the interesting thing about this is that if we go back to the Great Depression crisis, I'm just wondering whether
that would be Homestake, which is
Homestake mining.
Yeah,
absolutely. I've got the data for this.
When I got into it in 1927, That's when I was bar mitzvahed. I got out a little early.
Oh,
Just kidding.
oh God! Oh, for goodness sake, you must be joking. You've got to be joking. Oh, for goodness sake!
You know, when I was a young man before
Heck.
the last depression. Yeah, go
Yeah.
ahead.
Yeah, I mean, you and I should have long beards by now, right?
Yeah.
Yeah, because the longer it is, the wiser you are. That doesn't really make sense. Well, it used to make sense. It doesn't anymore. I'm going to try and find my home state mining chart, actually, but I'm not sure where I've got it. We haven't got much time. Maybe I come back to you on another time. But
Okay,
the one thing I was going to make on that comment was that home state mining, when the Dow collapsed in 1929, 1930, home state mining was already in an uptrend at that time.
Okay.
But it had a slight wobble to the downside, but then it continued moving up during the Great Depression crisis. And that was very important, because I think we've got a historical precedent there. So if you do want to go long of Newmont Mining and maybe some of these other mining stocks, they're probably a good way to, here we go. It's probably a good thing to hold them during any major collapse that you have, because here you can see well, it's covered up a bit, but there's a slight wobble.
Yeah.
But you can see that home state, which is in gold, had a slight wobble during the collapse. But look at that. I mean, it basically, yeah, it kept its trend going right the way through.
Yeah, it looks like 30 cents to 350 or something like it's 280. Can we? I'd like to know, the way you're talking here. Are you still a believer that the market, like we get one more washout in the market, if that ending diagonal works out, that the end of the bull market in equities could be by the end of 2019, and then from a past letter I read, then we enter a generational bear market? Is that still your timing, or have things shifted?
I'm just going to show you, that's a dollar chart, by the way. But I'm going to show you a, I'm going to show you, well, one of the, actually, I wanted to show you this today. This is the NASDAQ.
Okay.
And this is one reason why I believe that the secular bull uptrend is still unfolding. I think a lot of Elliott wave practitioners think that we've hit major top and there's going to be an almighty collapse. But I think that you've got to start looking at this in a just slightly, well, look at the NASDAQ from the October 02 lows. 1, 2, this is only wave 3. There's no fourth wave yet. We've been doing that, I think, over the last several months, even from the beginning of last year. And my downside targets may already be done. If we have one more swing down on the NASDAQ, that's it, finished. We're going up then. We're going to make new record highs. But coming back to your question, this is a long-term cycle of the Dow, which I featured in our annual video reports. And actually, I've offered this annual video report out to subscribers at very low cost pricing, which I can show you towards the end.
Okay.
And it's one of the charts. And you can see that I've connected the tops in 1835 and 1929, which is the 94-year cycle. And that gives us an idea that somewhere up, it could even extend to 2023. I have got some other cycles, which a friend of mine from Hong Kong.
That's good news.
Well, it would be, wouldn't it? I mean, I definitely think that we could stretch out to 2021. I don't think we're going to go through a top this year. We haven't got enough time to complete the uptrends in the commodities.
Okay.
And we haven't got enough time to finish like things like the emerging market indices that we track, and a lot of the biotechnology indices and the banking indexes. You can look at all this stuff and you come to the same conclusions. But I do comment on all of these types of things in our video.
Okay, how do people get it, buddy?
Yeah. Okay. Well, if you go to our website, wavetrack.com, you can go to the news alerts top right and click on stock index video here. And if you do that, it will take us to our blog, and you can read all the preamble. And eventually at the bottom, it will tell you how to subscribe to those videos. So that's stock indexes. We normally do a trilogy series. In this one, there's 68 charts, but the trilogy series next up is going to be commodities. and then we're going to do currencies in about 3 weeks' time. So keep a lookout for posts on those. But there's a lot of data in here, and as you can see, this is the entire list that we use. And I would say also, before I run over my time, we've also put in a lot of economic data points in, things like Robert Shiller's PE ratio, price to book ratios, price to sales, and they all come to the same conclusion that the secular bull uptrend is still intact. So, you know, you do have a look at those, and you can always, subscribe to our intra week. We publish the Elliott Wave Compass report twice a week, and if you go to subscriptions, you can see the subscription process for Elliott Wave Compass, and you can keep up to date on a shorter term basis with that. So that's really good news.
Okay, so I encourage people you could to follow Peter, and your Twitter handle and your website one more time for the viewers, www.wavetrack.com. It's a website, and your Twitter handle again, Peter, is?
The Twitter handle, that's a good question.
Yeah, you're not that active. You're not that active on Twitter. How about one last freebie? A Bitcoin.
I'm really bullish on Bitcoin now because we've just finished this correction down from the December 17 highs. And the clue to this was really this huge trading range. It developed into a descending triangle. So you got A, B, C, D, E, and then we broke down in this final phase. And I'm leaving this inset chart up because we've got an acknowledged 5-wave upswing. This is a correction. So Bitcoin revival, I think. I mean, it's that would imply that we go to
that'll put some smile on people's faces that are down 80%.
Oof.
So
well,
what kind of upside you think we'll ever see 18,000 Bitcoin again, Peter?
I'm just going to check my numbers because oh,
wow.
Yeah, something like, well, 40. This is log scale. So, but I, you know, if you work with log scale as often as I do, and you look at very long-term charts, you tend to trust these prices, even though they look fantastical at the time. But yeah, I think that this is a correction down. I think we've got higher highs to develop. Even if you say higher highs, you're still looking at huge multiples. So don't worry about the numbers.
Yeah. Okay. I really appreciate having you here, Peter. I hope 2019 is great for you. Appreciate you coming in and sharing your views and having a little debate. Manny is still debating you. So he's saying, he said he found something in a book, and you know, Manny, why don't you get a hold of Peter, send him an email to continue this. He says it is not incorrect, Peter, according to the Elliott wave principle. All the waves diagonal must be a zigzag. The only exception.
I'll just say one thing. I would just say one last comment on that.
Page 87.
One aspect is that everybody sort of refers to textbooks, and a lot of them are not always correct. Use empirical evidence, use your own eyes and your own research, and develop. Elliott wave was never, when Elliott finished his entire manuscripts back in 1926, he wasn't finished. And we have computers now. We can build up a big database on recurrence. So don't always trust what you see in textbooks, because they were written, most of them, a long time ago. They've never been revised and edited. And use empirical evidence, trust your own eyes and build up your knowledge base. That's the most important thing.
That's right. So it's not a Bible, because even the person who created this methodology knew his work wasn't done. I think all the great masters never felt they had it all, that it's an ongoing process, and that, if you're not growing, you're dying. So they were always looking to refine and tweak whatever they had. So
absolutely.
Great comment, buddy. And thank you again, Peter, my trading warrior brother, for hanging out with us today in F.A.C.E.
Great, Dale. Thanks so much too. And thanks for welcoming me so much. And I really do appreciate our our constructive comments and dialogue. So thanks again to you. You're wonderful, really fantastic.
Thank you, buddy. Mission accomplished. Some great ideas were shared. And good luck, buddy, and let's keep in touch.
Adios.
Adios. Okay, everyone, that's it. Hope you enjoyed today's webinar. And Peter, remember, don't just count your pips, count your blessings. Yen selling off, S&Ps are selling off. And we'll see everyone for TGIF tomorrow. I have Super Bear Elliotician who will have his own ideas, Henrik Zeberg, tomorrow. So good hunting the rest of the day. See you in members chat. Adios.